This is Jeff Herman from the Business Journal coming to you from downtown Youngstown, joined by Tim Petrie and Angela Johnson from Davis CPAs. And the topic of the day today is PPP loan forgiveness.
We're just going to go over a little bit of a recap, basically, of what the Triple P is, but we will focus mostly on the loan forgiveness portion, since at this point, a lot of businesses have already applied and received the money. You know, it is worth mentioning because there is still a lot of money that's out there. I believe it's about $140 billion. So we will discuss that. All right, so just as a recap, this is obviously a forgivable loan. It's generally for businesses with 500 or less employees. So this does include subcontractors, some eligible nonprofits, and, you know, sole proprietors. There are some exceptions for larger businesses and industries. And if you want to look further into those, you would just go to that SBA.gov to check out more information on that. There is a waiver of affiliation rules for businesses in accommodation and food service industries, franchises, and businesses receiving financial assistance under the SBA. There we go. There is no collateral required, and this does offer a low interest rate of 1%. Payments are deferred for 6 months, and then the loan is due in 2 years. There is potential for criminal charges on fraud, but a lot of these questions we've had have been clarified, which I'll get into. And then businesses with Triple P loan amounts over $2 million will be audited. So if you've got under $2 million, you are good, and I'll get into that a little more later. Again, there's still a lot of money out there. If you haven't applied, you can certainly apply now. One thing to keep in mind is that you can move to the next slide. Okay, so there's this 8-week period. And again, we'll get more into the actual forgiveness portion, calculations and documentation and application itself later. But just as an overview, you have this 8-week period that you're going to want to track your expenses. You'll want to maximize your loan forgiveness as much as legally possible. So of course, you know, consult with your accountant to see how we can do that. And then of the total eligible loan expenses, at least 75% have to be for payroll costs. Up to 25% can be for these other costs that are business rent, business utilities, and business mortgage interest. They have to have been able to be taken as a deduction on your tax return for these types of expenses, and they have had to have been in service prior to February 15th of this year. And then, of course, you will have to specifically request loan forgiveness via the application and necessary documents. And then it is very important, we keep saying this, but it's very important to keep separate detailed records as you're going through this loan forgiveness process. If you can establish that separate bank account and put the funds in there, and then you can see what's coming out as necessary, and then, you know, track everything that way so you have a clear, simple audit trail, basically. And then expenses paid with loan forgiveness funds are not deductible. So essentially this makes it income. So if we want to move to the next slide, we'll take a look at a quick example.
And I'd like to jump in here real quick on just on that last slide, Jeff. This is a perfect example and a perfect opportunity for us to illustrate kind of the fact that we continue to build the plane as we're flying it. In this scenario, what we're seeing, a couple of things to mention here is that when the payroll protection loan first came out, they were very specific about the fact that the loan forgiveness would not be taxable income. But obviously they came out with clarification later. They passed different laws that came out and said that the expenses paid with the loan forgiveness funds were not deductible, which essentially makes the forgiven amount of money income. In the same regard, the House passed a bill yesterday that is proposing to extend the forgiveness period from 8 weeks to 24 weeks and adjust the 75% limitation for non-payroll expenses to 60%. So there is a chance as we continue to look at all this, that there are some relatively drastic changes in the coming weeks. It's important for us to obviously take all of that into consideration, but what we're trying to do with any and everybody at this point is to continue to plan with what we know today, and then obviously continue to adapt as the rules change. But I figured this was probably the best time to mention some of those big changes that are potentially coming. There is undoubtedly some in the Senate. They've got some favor towards extending the period from 8 weeks to something larger. They've mentioned 12. They've mentioned 24. But this is the first time that we've seen something relatively concrete that looks like it has at least a chance.
So we're just going to say that you receive $100,000 in the triple P loan. And let's say that you have 100% forgiven, which is pretty rare now, but if this passes and becomes law, then, you know, there's a much higher chance to have 100% forgiven. So for simplicity purposes, we'll say that. Say you have $200,000 in Schedule C sales. So you're a Schedule C filer, and you have $200,000 on your 2019. And let's say you have $100,000 in total expenses, which would include forgiven expenses. So you would take that $200,000 in sales, subtract out your total expenses, and then you're going to add back in your total eligible expenses, as you see here on the right, of $75,000, because you can't take those as a deduction. And then you would arrive at $175,000 of net taxable income. So for those expenses, you know, you have to basically add them back to what you otherwise would have deducted using them. So it's not the forgiveness is not taxed as income, but the expenses cannot be deducted. Next slide, please.
Which is confusing as that might sound. You know, the simplest way to look at it from every small business's standpoint is that if you plan for and account for the money that is forgiven as taxable income, then you're essentially arriving at the same net end result.
Yep. So kind of going back to what I said before, these are just some best practices that you want to keep in mind. So if you can, try to create that separate bank account and then use everything that's specifically for this triple P fund out of that bank account. If not, just, you know, make sure you are keeping as detailed separate records as possible. Document, document, document. We really can't say that enough. It's only really going to help you once forgiveness time comes, and until we have further legislation or you know, clarification on forgiveness, that's really the best way to do it right now. So if you do offer former employees to come back to work and they refused, we've had this this was a very common question actually. Document that, you know, have an email, have it written out, and there's also on this website that you see here, there is that there's a form that will be there, but right now, I'll show you on the next slide in a minute, but you will be able to fill out that form, and you will want to just basically specify, you know, you've asked them to come back and they've refused. So you're, again, documenting that. You're not just having it be a you know, you've reached out phone call or whatever, you know, keep as much detailed records as you can, just to save yourself. And then of course you only want to use these funds for allowable uses. So for the forgiveness, make sure you know exactly what you're doing, you know, and again, if you have to consult with your accountant, you know, or tax professional, please do that, just so that you're not only maximizing your forgiveness, but that you're doing it as it's supposed to be done. And then look to the FFCRA and other provisions of the CARES Act. So, you know, maybe you decide you didn't want the triple P fund anymore, or you did. There are other provisions out there that could help you, and there are other provisions that coincide with the triple P program. So it's important to understand that if you are looking for alternative options or options in addition to the triple P, that you just know, you know, how they intermingle with each other, basically. And then you'll want to file your application once all is said and done for that forgiveness portion. All right, so we can go ahead and move to the next slide real quick.
And I think a quick question we might want to hit while we're here. This gentleman did not get PPP, but did get disaster money. It showed up in his checking account. Is this money also forgiven? Is it the same guidelines and regulations as the PPP?
Yeah, so the two definitely interact, but it is a different set of guidelines. So what he probably saw deposited was the EIDG, is the way that they label it in the account, which is the grant portion of the EIDL, which is the Economic Injury Disaster Loan. The EIDG, the grant portion of that, is you get $1,000 for every employee that you have up to 10 employees. You get a $10,000 grant in advance of your loan application that you filed for the Economic Injury Disaster Loan. The way that the two interact is that you can't get both. You can't get the $10,000 grant and still have $10,000 included in your payroll protection forgiveness. So, you know, in an example where you took both, then if you had a $100,000 payroll protection loan, the maximum amount you could get forgiven would be $90,000. More specifically, in regards to his question, the EIDL money is a little bit more loose in terms of how you can spend it. The payroll protection is very specific in terms of its allowable uses. The Economic Injury Disaster Loan Program is more of an easier program to use the money. You can use the money for expenses that you incurred prior to getting the loan. You can use the money for operating capital, for inventory, for a wide variety of expenses, and it's not necessarily just limited to payroll, rent, and utilities. So what I think is important is people consider how they spend that money if you got both payroll protection program money and EIDL money. But if you've only received one of them, then there is no forgiveness application. There's nothing that you need to do formally in regards to making that to receiving that $10,000 grant. But what happens with those monies is that you get the money first, and then within the next month you'll receive a notification in regards to the status of your application for a loan. At that point in time, you'll have a decision to make as to whether or not you continue forward with the actual loan itself. But that $10,000 still is a grant, and you don't have to pay it back. We would be under the assumption that $10,000 will still be treated as some function of income, whether it be a non-deduction of those expenses that were incurred with the money, or just plain picking it up as grant money. So something to be careful about in regards to the EIDL, but in general, they are two very different programs and require spending the money very differently out of either of them.
As far as if you offered an employee to come back and they refused, this is where you would go. This was just a screenshot that we took so you could see this is where it was, and then now it's obviously being reviewed and they're making some changes. So there will be a spot. You'll want to just make sure you're keeping up with the Ohio Department of Job and Family Services website, where you would go ahead and report that person that you tried to get back to work.
And the reason they've paused this program is because what originally this was intended to do was to pull people off unemployment that shouldn't have been on unemployment because they had been offered their job back. And in a normal pre-COVID world, that's what this was for. It was for reporting folks that were abusing the unemployment system. What they realized quickly was that it wasn't quite that simple. Was that there were reasons maybe that people weren't coming back to work above and beyond just the fact that they were receiving unemployment. So that was the consideration that they made, and it would appear as though they have paused this formal reporting so it didn't cause automatic interruptions to people's unemployment. It is still very important that in some way, shape, or form that you are documenting all of those offers to come back to work, and we'll touch on why that's so important here as we continue to go.
Yep. So Jeff, if you could just move to the next slide, please. This is just an example letter. If you wanted to use something like this, So if you, again, try to get someone to return back to work and you would include dates, times of your attempts at contacting them, then, you know, you can have this on file and just throw it in your triple P folder and know that it's there and you've documented yourself, and, you know, and that's the best way to be right now. So, you know, this is just our example if you wanted to use something like that. So now we can just jump into some other questions if we have any.
Yes, I am showing 2 questions.
I just answered one of them directly, Jeff.
Okay, then we are, okay, here we go. The remaining question, if original application was for $140,000, which was 2.5 times the payroll costs plus EIDL of 10,000, which had been applied for as a grant but not yet received, they received 150,000. So do we take the 75-25 of the 140 or the 150?
That's a very good question. Donna always asks very good questions. Good to see you here, Donna. I would anticipate that the 75-25 is going to be based off of the total amount of the loan. So when you look at the actual loan itself, I would be looking at whatever you received the loan for, and then how the money was spent. So the timing sometimes has been interesting, because what happened with many people was they submitted their triple P loan application and then received their EIDL afterwards. So they weren't necessarily wrapped up into the same equation. But what we're looking at is we're looking at the 75-25 being applicable to the amount of your loan that you received and how you spent the money specifically in regards to that. I think the simplest way to look at that is that when it comes time to the forgiveness, that EIDL probably happens at the end, and that $10,000 probably comes off at the very end after all the calculations are done. And if that's something that we haven't necessarily seen come into play a ton, just because we haven't seen how each individual bank will process the applications them on their own. But that would be how I would anticipate that happening based on what we know now.
Excellent. Another very good question. Are we able to hire new employees instead of rehiring our previous employees and still fulfill the full-time employee requirement? Our needs have changed during COVID in regards to what positions are needed. So that's a question that we're seeing quite a bit. Is it about just the count, or is it about the individual role, individual person?
So we will look at this a little bit closer later, but I can tell you that it's all about the count. They're going to look most closely at the actual full-time equivalent count based off of a 40-hour work week. There are multiple different ways to calculate the full-time equivalency, which again will make a big deal in the different methods that you can use to calculate your forgiveness. But yes, it is specifically in regards to the count itself.
Okay. Another question, are part-time employees counted as 0.5 each?
Well, so there are 2 different ways to calculate that. And this is where we're looking very closely at how we calculate this. And it's not just as simple as doing it one way. I think what's going to end up happening for most of our clients, we have kind of a process that we've built where we're looking at some of the basics to try to streamline it. We've looked at it in the way that 1040s used to be organized, because we're accountants, right? And we think in 1040s. So there's 1040s, there's 1040 EZs, and there's 1040 As, okay? Or there used to be at least. The 1040 EZs, or the loan forgiveness EZs, are for the people that they have more employees than they had last year. They're going to spend all their money. It's going to be a relatively simple calculation. You start to get into the more difficult things as you are looking at, if your count has decreased and your dollars have decreased in terms of what you spent on payroll this year versus last, you're going to have to get in the weeds a little bit more as to how some of these calculations are done. The full-time equivalent is a good example of that. There's 2 different ways that you can do it. The basic way is how we started with everybody, was that we just did your total hours divided into 40. And whatever number you came up with, rounded to the nearest tenth, was going to be your full-time equivalent count. They came out and gave us another option that said you can use the simplified approach and say, if your 40 hours are over, you're 1 full-time equivalent. If you're under 40 hours, you're 0.5. So if you think about how that math may be beneficial to you, if you have a lot of people that are, 39-hour-a-week employees, then that simplified approach is going to be a much better option for you, because you're going to get to round down to that half versus round up to the exact tenth. And while we may be talking about some really minor numbers, when we're applying that against your forgiveness, that could make a pretty big difference. And again, we'll look at that a little bit more detail with some examples later.
Right. And just so you know, from a showmanship standpoint, I did stop sharing the slides simply because the Q&A is a big gray slide, and from a production value standpoint, it looks better on Facebook if I can see your face, Tim.
Gotcha.
And Angela. So we'll reshare. We'll reshare the slides when we're back. But there are several more good questions here.
Well, you know what, Jeff? I actually want to just interject for a minute, because I feel like a lot of these questions will be answered when we go through our next slide. So like that FTE we talked about and whatnot. So maybe we want to hold off just a little, because we do have a lot to cover. So maybe just hold off on our Q&A and see if we can answer those questions before that.
All right. Well, let's do that. Let's do that for sure. Then we will go back to sharing the slides.
Let's see.
And
maybe we won't, but I think we might. All right. So just jumping back into this, and then of course we will address what questions that you have. So we just wanted to go over 10 newest updates that we've come across that feel you should know. So the first that we have here is this good faith necessity. So again, if you have a loan that's less than $2 million, it'll automatically be deemed as necessary per the SBA. So anyone under that, if you just automatically get that, it's you need it. So this is per the SBA. The SBA has determined that this safe harbor is appropriate because borrowers with loans below this threshold are generally less likely to have had access to adequate sources of liquidity in the current economic environment than borrowers that obtain larger loans. This is basically explaining why. So this safe harbor will also promote economic certainty as PPP borrowers with more limited resources endeavor to retain and rehire employees. In addition, given the large volume of PPP loans, this approach will enable SBA to conserve its finite audit resources and focus its reviews on larger loans, where the compliance effort may yield higher returns. So just know that if you have less than that $2 million for your loan, that you're automatically good as far as the necessity requirement. One question that was popular was, what if I got too much for my PPP loan? Maybe based on guidance that came out and then, guidance after the fact clarified something, and now you have to go back and adjust as needed. Whatever the case, you can always pay back the excess, but you might want to hold off on that until once again further guidance comes out as far as the forgiveness portion, as we still have pretty much a gray area there. Of course, we do have a lot of our questions answered, but we still have questions in addition to that. So just know that May 18th deadline that had been extended was for if your loan was necessary, not if you've received too much of it. So we can move to the next slide. So our second point that we want to mention is very important. So there is now this alternative covered period option for your forgiveness. Now this is only for payroll. This is not for your non-payroll costs. So for only payroll, the 8-week period can begin the date the funds are received, which we knew that, or the first day of the first payroll period after the loan disbursement. So for example, you received PPP funds on Wednesday, April 15th. The covered period may start the following Monday, April 20th, if you choose. It will just make pay periods match up much better and just make things much easier. But it is your choice. So does this mean that we can delay our first payroll cycle to, when you're ready to start everything up and running and use that alternative covered period? That's kind of a question that we have, and we're not really sure, because, that would definitely make the difference for a lot of our clients and a lot of businesses out there. If you just waited, but, hopefully we aren't the only ones with that question, and I'm sure we're not, and that we'll get more clarification on that. So for number 3, we have eligible payroll costs that have been better defined. So, they're considered paid on the date that paychecks are distributed or the borrower originates an ACH credit. They are considered incurred on the day that the employee's pay is earned. Now, this is important, this next one. Payroll costs must be paid during the covered or alternative covered period, or payroll costs can be incurred but not paid during that period that you choose if they are paid on or before the next regular payroll date. So basically what this is saying is as long as you're paying your payroll costs during that covered or alternative covered period, or you're incurring those costs during that covered or alternative covered period, those are eligible for forgiveness, as long as you pay the ones that are incurred on the next billing cycle, even if it's after that 8-week period. So I know that's a lot to throw it to, but it does help as far as, maximizing your loan forgiveness. Also, total cash compensation for each employee may not exceed an annual salary of $100,000 as prorated. So, and it cannot be greater than $15,385. And you can only count payroll costs that were both paid and incurred during your period once. So you can't double dip there. So let's remember what constitutes eligible payroll costs. So we've gone over this before, but we just want to review with you that eligible payroll costs include salaries, wages, commissions, or similar compensation, cash tips or equivalents, certain leave, although family and sick leave under the FFCRA do not count for this purpose, allowances for dismissal or separation, group healthcare benefits and retirement benefits, but benefits like healthcare insurance and retirement costs do not qualify as covered payroll costs for owners. But if you are a shareholder employee of an S Corp, let's say, then they do, and we will touch on that a little bit later. Also, you have state or local tax assessed on compensation of employees. So this is the employer portion of state or local tax, and we have been including unemployment here, state unemployment. And also guaranteed payments to partners are eligible payroll costs. And we also have bonuses or hazard pay. So we're encouraging that, of course, with everything going on, the essential workers, let's try to maximize this by paying out that hazard pay as needed. All right, so the next thing is non-payroll costs. So these have also been better defined, and it kind of coincides with what I said about payroll as far as being paid or incurred. So they must be paid during the covered period. Now notice that there is no alternative covered period for these types of costs. They must be paid during the covered period or incurred during the covered period and then paid on or before that next regular billing cycle, even if the billing date is after the covered period. So this is very similar to what I talked about with payroll, but the difference is here that there is no alternative covered period. Okay, we can move on to the next slide, please. So again, just as a recap for non-payroll costs, eligible non-payroll costs include business mortgage interests, rent payments and leases, and utility payments for businesses, all dated before February 15th. So these services would have had to be in place before February 15th of this year. Utilities include electricity, gas, water, transportation, telephone, and internet services, all before February 15th. And one thing that's been recent that we hopefully will have more clarification and guidance on is it seems that you might be able to take business mileage as transportation costs because technically those are deductible. And so, if you're a Schedule C filer, say, and you take business mileage on your tax return. We're not entirely certain that this is the case, but this is a topic of discussion that, you know, it's possible. So business rent or lease payments also now include real or personal property. So originally it was just, you know, if you paid rent on your building, that's it. But now it's for real or personal property. So just in case you're not aware, personal property is movable property. It's anything that can be subject to ownership, just not land. And real property is immovable property. So it's land and then anything attached to it. So this just opens up the door for so much more. You know that you could include machinery, equipment leases. It's not just buildings now. So that's important to keep in mind, that as part of those other eligible costs, these are now extended as well. Okay, so another change that we've seen is this limitation on owner compensation. So owner compensation may not exceed 2019 compensation divided by 52 weeks times 8 weeks. And it may not exceed $15,385 during that covered period. Some questions we've seen: how do I pay myself if I'm a sole proprietor in order to maximize forgiveness? Sole proprietors aren't employees. So first, the payroll period doesn't apply. And based on recent guidance, you'd automatically get the forgiveness for your 2019 compensation divided by 52 times 8, not to exceed that limitation there. As far as additional income verification, the SBA hasn't said anything about that, but you will have to verify your other non-payroll costs in this situation. So that, again, be your business, mortgage, interest, utilities, rent, things like that. Another question we've seen is if you and your spouse are an LLC together, are you counted as one employee or two employees when applying for forgiveness? So as an owner of the company, you're not an employee at all. If there is more than one owner, you just need to provide a list of each owner and his or her compensation as it applies. And then going back to what we did touch on earlier, what about S Corp shareholders who are on payroll? Compensation is capped at the same thing. So at 2019 owner compensation divided by 52 and then multiplied out by 8, and it's capped at $15,385. So it includes both cash compensation and employer retirement and healthcare contributions made on your behalf. And lastly, it applies across all businesses according to most recent guidelines. So another change that's out there for this is, as Tim mentioned in our Q&A, this simplified calculation option for your full-time equivalents. So originally we weren't sure if it was based on 30 hours or 40 hours. Now we know that it's based on 40, and it was only based on your actual hours. Now there is this simplified method that's been added. So basically all you're going to do is anyone who works 40 hours or more, you would use 1 as their assigned FTE. Anyone who works less than 40 hours gets assigned that 0.5. So that's, again, what we were talking about in our question and answers. If we can just move to the next slide, we'll show you a little bit of an example. So let's say you have a company who pays out bi-weekly for their payroll, and you can see the employees listed here, and we have the amount of hours that they worked in 2 weeks. You're going to take in column D, there's that 40-hour calculation. So you're just gonna, you know, at the bottom there, the easiest way is just sum those up, divided by 80 for the 2 weeks, and then you get your FTE count. That's the actual way. If you use the simplified way that's now out there, you would just assign a 0.5 for anyone who's under the count, or 1 for anyone who works full-time. And then you wouldn't have to add anything up as far as like to divide. You would just add those numbers themselves. And you can see that in column E where it's 4.5. So there is a slight difference, but on a larger scale, this could make a big difference. Next slide, please. So there is this FTE reduction safe harbor, and we did talk about this as well, but if you have people who have left, you won't be penalized for this as long as you're documenting it and you can show that and substantiate it on your application. So if you've tried to hire back an employee who rejected, if you had an employee that you had to fire, if you had an employee voluntarily resign, or they've requested a reduction in their hours, these all apply to that, and you will not be penalized. Your reduction won't be reduced if this is the case. You would just be able to include them essentially in your FTE count, saying that, because of this safe harbor, that it applies to you. So, and again, as long as you are restoring anyone who doesn't fall within this category. So if you have reduced your FTE headcount, right now, June 30th is the date. Right now, I say, because it's very likely that it could change. But as long as you're restoring anyone else by that date, then your reduction and forgiveness will not be affected. So just moving to the next slide. So for the FTEs, first you're going to want to calculate the periods on the left there, just so that you have those. And then, again, we did talk about that, but for purposes of the webinar, if you have questions, you just ask us. So FTEs, you'll calculate for those. Then you're going to choose and calculate either your alternative cover period or your covered period. And then you're going to look to the safe harbor periods as necessary. Those safe harbor periods are what's new. Next slide. Another safe harbor is this wage reduction adjustment. So it's providing detailed calculation to assess if wages were reduced, and introduces the safe harbor calculation to test the entire group first, rather than having to test each individual employee. Now, Tim, did you want to chime in on this part at all? I know it's just a brief slide here.
Yeah, so this one is one that will save everyone a tremendous amount of time and energy when they're trying to do their forgiveness applications. This little safe harbor will allow you to do one calculation rather than potentially hundreds of calculations. Originally, it was written where you had to compare everybody's earnings during the cover period, each individual employee's earnings during the cover period, against what they earned in the first quarter of 2020, which on the surface of it, may not seem like a big deal, but when you've got a large group of employees, that can be a ridiculous amount of data. So what they came out and they said is that you could use a simplified approach here. So you could calculate this based off of average salaries. The simplest way that I've looked at it is you can do it based off of hours. You can take your total amount of money that you spent, and you can divide it by the total amount of hours in your workforce in the first quarter of 2020, and then you can do the same calculation during your covered period and take your total amount of money spent on payroll and divide it by your total hours worked. And as long as that number that you're left with in your covered period is 1 or greater, you don't have to go through and do the detailed calculation. So this is where we kind of talk about breaking this down into categories of, easy forgiveness application and intermediary forgiveness application, and the long form, we'll call it forgiveness application. This would be a way for you to qualify for an easy application. Even though they're all in the same form, you're basically going to check the box and say, yes, I've met this requirement. And we've tried to encourage this with a lot of people throughout, is that this wage reduction adjustment really only applies to the companies that went out and enforced wage reductions during this pandemic. They went out and said, look, we're going to implement a 25% pay cut across the board. As long as you've returned people back to where they should have been in the end, you'll get the exemption. But this allows you, for those that never even reduced those average wages for your employees, will allow you a simple and cleaner way to just check the box saying, yes, our average hourly rate was 20 bucks an hour prior to this. Our average hourly rate was 20 bucks an hour during the covered period. We don't have to get into the nitty-gritty of looking at each individual employee and comparing their compensation during the covered period and in the first quarter of 2020.
Awesome. Thanks, Tim. Jeff, yep, thank you very much. So our last one here is document retention. So once again, documentation is very, very important. And then you'll have to retain these documents for 6 years after you receive loan forgiveness.
And this is important from the standpoint of preparing for down the road. Okay, so what we're always talking to people about when it comes time to taxes is how many years can you be audited, right? So how many years back can you be audited? And typically when it comes to tax returns, you're looking at 3 years from the time that you file your tax return, unless you've committed some type of fraud or some intentional wrongdoing. Then you have obviously a longer period, a statute of limitations where they can go back and audit this. This sets the tone in terms of telling you what that statute is going to be or could potentially be. It may take us 6 years to catch up on these. They're going to be, at some point in time, as we continue to get outside of this, they will be looking at the ones that have a higher level of potential fraudulent scores. They may not do it right away, and you may go 2 years thinking, I got one over on the government, but eventually they will find the ones that were clearly fraudulent. Be cautious, be careful. You're only setting everyone else up for a bigger disaster later if you're fraudulent in how you're handling this, yourself primarily included. So our encouragement is keep your documents, do things correctly, make sure that you're safe, that you're not going to get surprised later. And they will undoubtedly hold people some level of personally liable if they find out that you were doing things blatantly incorrect. If you were fraudulent in the way that you either applied for the loan or for the forgiveness, you've got a 6-year clock from the time after loan forgiveness, not from the time that you've got your loan. So we felt this was important to mention because this starts to set the tone and precedence for what we can continue to expect moving forward.
Yep. So we can move to the next slide. So as Tim did mention, there is this possibility that the 8-week period will be extended to 24 weeks, and also the elimination of the 75% rule for payroll costs. So these are very important, and let's cross our fingers and hope that it gets passed and put into law. It'll just make things easier and maximize our forgiveness. So we'll jump into just a little bit of Q&A, Jeff, but just a few, and then we'll just continue on and wrap up with some more questions.
I've been firing through these things while you've been going, Angela, so I've tried to mow them down a little bit here.
Yeah, Tim's a Q&A machine today. He's answered 16 questions already without personal intervention, so good job, Tim.
Wow.
So would you like to handle these now, or would you like to continue?
Sure. We could do these ones live if you want. We only got a couple of them here.
Okay, good. So on number 6, owner compensation guaranteed payments. If the company had a loss in 2019 with no owner compensation, you cannot make a guaranteed payments in the covered period, ?
Yeah, so the way that the law is currently written is it will be limited to your prior year compensation paid. I would venture to guess, and we've run into that a couple of times, I'd venture to guess that those would not be includable in forgiveness because it's going to look back to that limitation of 2019. Now, that could very well change between now and forgiveness. They could provide some clarity. One area that Angela and I pay a lot of close attention to, and it's on Angela's calendar. She starts her day off every day. She sits down with her cup of coffee at God only knows what time she starts working in the morning. And she goes to the United States Treasury's website, and on that website, there is a frequently asked questions PDF file that they update almost every day. and they'll put in on that website the date that they most recently updated it. Those frequently asked questions are where we're getting a lot of our interpretations to this, because they're not necessarily issuing new laws or guidance, but they're addressing specific scenarios like this. That has not shown up yet on the frequently asked questions, but if I were to have received a loan and I were in that gentleman's position, I'd be paying attention to that frequently asked questions section of the United States Treasury's site.
Excellent. Next question: for an employee that was terminated during the covered period, would they still be included in the full-time equivalent number because they were employed at least one pay period of that covered period? Would you consider their salary as being reduced?
Okay, so we'd have to look at two parts of that question, right? Is that, and this is where we get into our interpretation of words, right? So if that employee was terminated for cause, and if you have specific documentation that you got rid of them because they didn't show up on time to work, they violated some type of work policy, you had a reason to terminate them, then you would qualify for the exemption from including them in your FTE count and your reduction of salary count. Now, if you just terminated them because of lack of work, then they cannot be included in your FTE count. They're going to count negatively against your forgiveness from that standpoint as well.
Okay, excellent. And then last question in this section: how will lack of overtime factor into the wage reduction adjustment safe harbor? We did not cut anyone's hourly rate, but due to a lack of business, we did cut overtime, which had been worked and paid prior.
Yeah, so this one has been addressed in terms of the frequently asked questions. The answer to that, as long as you haven't reduced your hourly rates, then you won't have an adjustment. I can't necessarily tell you what specifically you will be required to prove at some point in time, but I think that that's one of those things. When we get to the forgiveness application, you'll see there are certain documents that are required to submit with your application, and then there are certain documents that are required for you to keep in the event that they interview you or ask more questions later. So that would be something that, again, I would encourage you to make sure that you have some proof that says these are our hourly rates during the first quarter of 2020. These were our hourly rates per employee during the covered period. And I would think that that would be substantial enough to protect you from a reduction.
Excellent. Okay, so that clears the Q&A queue for now, and we will go back to the show.
Yeah, so we're just going to wrap up this last part here with the application itself and then the forms that you'll have to submit. So you will have to, of course, submit the application, and then along with that, there is the Schedule A that you'll have to complete, and then some necessary documentation. There is this optional borrower demographic information form that you could fill out, but it's not necessary. Next slide. So for payroll, you'll want to keep bank account statements, third-party payroll service provider reports, all documenting the amount of cash compensation paid to employees. You'll need to include certain tax forms for the periods, so like your Form 941. You'll want to keep payment receipts, canceled checks, account statements, documenting the amount of employer contributions to employee health insurance and retirement plans, all for that forgiveness amount. So documenting is important. Next slide. Sorry.
I have to insert a bit of a plug here, is that the Payroll Protection Program loan reports from White Glove Payroll are beautiful. They've turned out great. Our programmers did a really nice job. I hate to admit it, but many of the other payroll providers have also done a very nice job in regards to their report sets for people to track this. So if you process your payroll with White Glove Payroll, with ADP, with Paychecks, with Paylocity, with Prime Pay, with many of your larger payroll providers, have some really nice reports that all you have to do is log into your payroll processing system, and you'll see it clearly marked as payroll protection loan reports, and you can run those reports specific to what you need. What I will encourage you to make sure that you're very cautious of in using those is that I don't know that they will be including all the various different options for different calculations of full-time equivalents, as well as some of the other different periods, whether it be choosing the 8-week period following after you received your money or your alternative covered period. Not all of the payroll processing reports have been built equally in that regards. So make sure that you're using those tools when it comes time to forgiveness, because that difference in that FTE count or that difference in that covered period could be a big difference in your calculation of your loan forgiveness. So it's great that those reports are there, but just make sure that you do the due diligence to check that next step to make sure that you're increasing your loan forgiveness. I know that HD Davis, amongst many of the local CPA firms, have now become open to getting more involved in helping people with their loan forgiveness applications and calculations as there have been more clarity. I would strongly, strongly, strongly recommend you engage a professional to help you with this calculation, especially if you have more than just the basic application for forgiveness. Most of those professionals are more than happy and willing to jump in and help you with that application.
All right, so Tim did talk about this a little bit, the FTEs. You'll have to keep documentation on those. So we can just move to the next slide to keep things moving. For non-payroll, again, you have your business mortgage interest, business rent, and business utilities. So you'll want to keep documentation as shown here. So like your amortization schedule, receipts, canceled checks, invoices, account statements, anything that's going to help substantiate your numbers where you're getting those. Next slide. Other documentation you'll just want to retain. So this is important, although you don't have to submit them, are the P Schedule A worksheet or its equivalent. So if you have something internally like a spreadsheet, make sure you're just keeping that. Documentation that's going to support your worksheet or spreadsheet. So numbers you're going to be inputting on the Schedule A. Also, if you have, once again, people that you've offered to come back, if they've been fired for cause, voluntary resignations, or they've requested to have a reduction in their hours, keep documents of that. And then also supporting documentation on the Schedule A worksheet FTE reduction safe harbor. This is just to show you what the application looks like itself. So you have obviously some basic information you'll have to fill out. A few things to keep in mind are where it says the employees at the time of loan application and the employees at the time of forgiveness application. These aren't FTEs. These are just the number of employees that you have at those times. There's also this line for the EIDL advance amount, and you'll have to also put the application number. So you want to make sure you're putting that there. And then the SBA will do its calculation for the loan amount itself, and this, this advance amount here. You don't have to put that really anywhere else on this application. Then of course, as you go down, you'll see where you have to input your payroll and non-payroll costs, any adjustments that you have, and then your potential forgiveness and what you're saying that you should have forgiven.
And a strong encouragement from a guy that lived through round one of this, in staying up throughout the night and working on 6 different versions of the initial application for the loans themselves. We're encouraging people not to place too much faith into this application as the final version. Maybe we'll get lucky and maybe this will be somewhat of the final version, but I've got a sneaky suspicion that this is going to be quite different when it comes time for forgiveness. So just be careful. Don't get too lost in the weeds here in regards to this specific application. Don't be married to it. There's a great chance that it's going to look drastically different when it comes time to forgiveness. In the same token, there's also a great chance that every bank's going to do this a little bit differently. You got to remember that the banks were very much so overwhelmed with the initial application process. Now, when it comes time to the forgiveness process, we're asking the banks to do a tremendous amount of work in reviewing these things. So many of the banks, you may see some online versions, some in-person versions. Just be cautious in regards to spending too much time and energy on that. Just talking from experience, obviously, and just make sure that you've got as much of the information ready to go as possible. We do have a Excel calculator that we have worked with a variety of other local firms to put together. And we have been using that in conjunction with some of the banks in terms of tracking the funds for people thus far. It doesn't look anything like this application, but it at least brings all that stuff into one place so that you've got an easy place to pull the stuff from your tracking to the application. But again, knowing the different options you've got when it comes time to forgiveness, don't be shy about calling on the professionals to help you make sure that it gets done correctly, because it'll be real dollars, the difference between doing it right and doing it wrong.
Very good points. Thank you. So this is just other part of the application where you would initial and sign off. We can move to the next slide. This is the Schedule A worksheet that can help you prepare the Schedule A. Again, it's not necessary to submit as it is right now. And just know that the instructions that come along with the application and all of these forms are very helpful, and they actually do walk you through each step and basically give you what you need. So refer to those as you're completing this. We can move to the next slide. And then this is the Schedule A. So you would be inputting all of your information on here and then including that along with the application itself. Next slide. So finally, before we wrap up, you are going to owe if any of these apply. So if you're not using the loan over your covered period for payroll costs, mortgage interest, rent, utilities, you don't restore your FTE count by June 30th, if you have that reduction in pay and you don't restore it by June 30th, and then if you've received that emergency advance from the EIDL. Next slide. And then we just wanted to let you know that for HD Davis and Wycliffe Payroll, we now have this 7-step process for maximizing loan forgiveness. If you would like to request one, all you would have to do is go to either of our websites here where we have, shown, and then just put in your information, tell us a little bit about your situation, and we'll send that to you. We just really wanted to try and simplify this for you, and because it is a lot, and just to see if that, if it can help you in some way. So just be aware that this is available to you. And also we have been updating our HD Davis website regularly with some other COVID-19 resources on that COVID-19 resources tab, should you need additional information. And of course, if you need to contact us directly, here is our information. Tim and I and all of our team would be happy to help you. Of course, this is not an easy time and things get confusing and overwhelming, and we get it. And we just really want to help you and, do our best to just provide you with, what we can.
Donna asked, I didn't understand the last line of the last slide. You will not be forgiven if you got an EIDL grant. The clarification there is that you won't be forgiven to the extent of the dollar amounts you received as a grant. So again, if you got $100,000 in payroll protection money and you got $10,000 in the EIDG, which is the grant portion of that program, then that $10,000 is excluded from your forgivable portion of your payroll protection program loan. So the maximum amount that you could get forgiven in your loan would be $90,000. The intention there obviously is just to not double dip. As much as we like to double dip as often as we can, when within the confines of the law, this is one that they've clarified and said you can't have both. Qualified expenses must be paid or incurred. Does that mean a business can pay next month's rent and utilities before the covered period ends and they would be eligible for forgiveness? So the important thing to remember here is that you're allowed to pay for the expenses that you incurred during your covered period. So what that means is that you've got a little bit more options for your non-payroll expenses. Now for rent, you should be paying your rent for the rent that was incurred during the period. So if you got the loan April 15th, you should pay 2 months worth of rent. You should pay 2 months worth of utilities. You should pay 2 months worth of your non-payroll expenses. What you can't do is pay ahead. You can't say, well, I've got all this money and I'm going to pay 2 more months of rent or 2 more months of utilities. They've given us some extra flexibility here because utilities naturally are difficult to pay within that time frame. So they're looking at your invoices and they're going to tell you, okay, if your 8-week period is up on June 30th, but you don't get your utility bill for June until July 15th, you can include that even if it's paid out outside of June 30th, but as long as it's paid within that due date that they provide to you, that's covered for that period. So it's important to try to take a step back and use as much common sense as possible when it comes time, because that's kind of what they're coming back to is you need to pay 2 months worth of expenses. And those are going to be the ones that are going to be includable in the program. They do give us a little bit of leeway in terms of timing there, but that's the best rule of thumb I can give you as far as that goes. How might the rent change if we extend to 24 weeks? That's far more than two rent payments. I don't know. That's one that, I'm not afraid to be that guy that admits to not knowing. I have a long list of questions that by the end of the weekend, I'll fill up this whiteboard with all of those questions in regards to the proposed 24-week period, because obviously that changes the game and probably gets a lot more people to 100% forgiveness. I would venture to guess that if that does happen, we'll have a more extended conversation, potentially another follow-up webinar or more series of newsletters. I can undoubtedly say anytime there has been updates, we've tried to get them pumped out to people as early and often as possible. With this one specifically, it would undoubtedly change this entire process. So we'll look a little bit closer as we get more rules there. We try not to give too much faith until something becomes a law, because there's so much that can change between the time that it's presented to the time that actually becomes a law. In this scenario, we've spent a heck of a lot more time paying attention to things that are still bills, so that we can be as prepared and proactive as humanly possible. But that one will be riddled with a variety of new options and rules for the 24-week period. And Donna, I will follow up with you directly on your question in regards to the EIDL. We'll hop on the phone and we'll walk through that one a little bit in more detail. What else did we miss here?
If loan was received on the date of a bi-monthly payroll, is that full payroll included in the qualifying payroll costs?
So you get two choices in regards to that, and this is where we talk about your options when it comes time to using information for your forgiveness application. You've got the choice. Let's say that you got your money on April 15th, and your payroll ran on April 16th. That payroll was technically for the payroll period prior to April 15th. It was for the first 2 weeks of April, right? You could start with that pay date, right? So you could start with your April 16th pay date, and your 8 weeks begins on the money that you receive. The 8 weeks begins on the date you received your money, okay? Or you could choose the alternate covered period, and you could start your 8 weeks based off of the payroll period that begins after you receive your money. So that gives you the flexibility to look at more options and potentially extend your 8 weeks a little bit further, because as we're on the rebound here, your payroll could be increasing, your numbers could be increasing. It may be of more benefit to push that out a little bit longer because your later payrolls may be a little bit larger. So the alternate covered period is one that can benefit you by pushing things out a little bit. The one question that I had in regards to that was, what happens to the company that doesn't pay a payroll for a month? It doesn't have an actual payroll cost for the first, even though maybe they got their money on April 15th, they had 0 employees when they got their money. What happens if they don't go back to work for 2 months and they don't run payroll until then? That's a question we're still waiting on some guidance for in regards to what happens in that scenario. It's been pretty rare. It hasn't happened super often, but so my understanding is that the alternative cover period only applies to biweekly or less payroll periods. There's no real specific guidance that I've seen in regards to excluding anyone from the alternate covered periods as it stands today. They do ask those questions on the forgiveness application, so they may be leaning towards adapting to that. But the idea was to try to make it more practical. So if you have the ability to track things and line up a little bit neater with your normal payroll periods, you're fine. But worth, again, considering with whatever bank you have, whatever rules they may have, in continuing to pay attention to those frequently asked questions.
Great. Our last one looks like qualified expenses must be paid or incurred. Does that mean a business can pay next month's rent and utilities before the covered period ends and they would be eligible for forgiveness?
That one we already answered was yes, you could still pay them after the covered period as long as they were incurred during that period in regards to your non-payroll costs. That was the big question we had, was for utilities that are billed in the month after the month that they were actually incurred. So as long as you pay them at their due date, then you should be fine there. Then another question just came in: if a loan was for 2.5 times payroll and your employee count did not change, is it all forgivable? Not right now, because technically you got 2.5 times payroll, right? You got 2.5 months of payroll and you only have 2 months to use it. So if your numbers didn't change from last year, then you're still going to be left with that half, right? So you're going to be left with a half a month's worth of payroll. And if you don't use that half a month's worth of payroll on rent and utilities, then naturally, you're still going to have some money left over. Based off of what we know today, I think it's very unlikely that anyone, that most will receive 100% forgiveness. Now, there are some obviously that will, because they were a little bit younger in their business last year and they started to develop as the year progressed, and now they have a lot more employees today as they did last year, and a lot of those calculations were based off of last year. But if your business didn't change much from 2019 to 2020, it's unlikely, based off of the 2.5 times in 8 weeks to use it, that you'll use all the money, especially being in Northeast Ohio where rent isn't that crazy expensive. It's going to be difficult to use up that extra half left over on non-expenses. So.
Okay, another question. I received an email to advance my EIDL loan. I checked the banking info that they have and it is correct. I have not received the advance. I checked the box to receive the advance on the application. Is something amiss with the advance catch-up?
Could be. What I will tell you from our experience is that the folks at the SBA have done a tremendous job of being able to answer questions and follow up with scenarios like this. We had a couple of those types of issues for some of our clients. They were all extremely helpful, maybe not necessarily having the answer right away, but we called them and told them exactly the scenario. Within a couple of weeks, they got back to us and it was resolved. So I would strongly encourage you to look back to your email, look at your contact information. It'll be a long time on the phone. I'm sure it'll be a long wait. Encourage you to be as patient as humanly possible in regards to that. But the SBA folks have done really an above and beyond job in regards to getting back to people and answering their questions like that.
Excellent. Well, Tim and Angela, that concludes the queue of Q&A questions. And once again, this has been an amazing presentation. We certainly appreciate the ongoing insight into this fast-moving process, this fast-changing process. And I expect we'll be doing this again very soon. And for everyone that's still here, this webinar will be available in its entirety. The full recording will be posted most likely by the end of the day today on businessjournaldaily.com. Please make sure we will also include a link to that, the downloadable guide that Tim and Angela at HD Davis CPAs have developed. That's going to be very important. It's PPP loan forgiveness. You said a 7-step process, Tim? Tell us about that again.
Yep. So we've tried to look at this from the standpoint of trying to simplify everybody's process when it comes time to forgiveness. And we did that obviously selfishly because we have a ton of clients that we're helping with this. So we've tried to carve them out into their own various little buckets of simple, intermediary, and difficult. And here are the steps that you should follow to at least determine what you should be looking at. So it's a very high, 30,000 feet up kind of assessment of here are the things that you should look at and here are the questions that you should ask before you're submitting that application.
Excellent. Well, great. That will also be linked up in the story. So with that, I believe we can conclude today's webinar on PPP loan forgiveness. Thank you, Tim. Thank you, Angela. This has been amazing. You were very generous with your insights on this process, and we certainly do appreciate it, and we'll certainly be doing this again real soon.